Welcome, everyone. It is Monday, February 23rd, and this is the CB3 Financial Weekly Podcast update. The Supreme Court strikes down Trump's IEEPA tariffs in a landslide 6-3 ruling, but the White House fires back within hours. Fourth quarter GDP comes in at just 1.4%, well below expectations, as the government shutdown leaves its mark on the economy. And NVIDIA, 7% of the S&P 500, reports Wednesday after the close. Wall Street expects a big $65.5 billion in revenue. What might happen if that is a disappointment? Stay with us. It's the CB3 Financial Weekly Podcast, and it starts now. Let's start with the biggest story of the week. On Friday, February 20th, SCOTUS, the U.S. Supreme Court, delivered a 6-3 decision striking down President Trump's sweeping tariffs imposed under the International Emergency Economic Powers Act, commonly known as IEEPA. Chief Justice Roberts, writing for the majority, even though he's the lead Republican, joined by Justices Sotomayor, Kagan, Gorsuch, Barrett, and Jackson, ruled that IEEPA simply does not authorize the president to impose tariffs. This was the first time a president had ever used IEEPA in this way, and the court said the statute, which allows the president to regulate imports and exports during a national emergency, was never intended to grant unilateral tariff power. Now, why does this matter to you as an investor? These IEEPA tariffs have generated roughly $130 to $160 billion in revenue for the U.S. Treasury. Estimates suggested that they would have raised $1.4 trillion over the next decade. That could have been applied to the U.S. debt cycle, and that would have been terrific, but it's now off the table. But, and this is a critical part of the story, within hours of the ruling, and in fact, he even hinted at this in his press conference just an hour after the ruling, the president signed a proclamation under Section 122 of the Trade Act of 1974, imposing a temporary 10% import surcharge globally. But by Saturday, he had already bumped that to 15%, which is the maximum allowed under this Section 122, dating back again to 1974. Treasury Secretary Bessent said the administration expects virtually unchanged tariff revenue in 2026 using this alternative authority granted by Section 122. The challenge is that Section 122 only allows for 150 days of tariffs without obtaining congressional approval. So the markets initially rallied on this ruling. The S&P closed at 69.09 on Friday, up about 0.7%, a really nice gain. The Dow finished at 49,626, but that's off its highs. If you remember from our last podcast and on the show, CB3 Live for February, I mentioned we'd crossed 50,000, so it's below that. Investors viewed the ruling as injecting more procedural constraint and less headway volatility into trade policy. But make no mistake, tariff uncertainty is a long way from over. Section 232 tariffs on steel, aluminum, and autos remain fully intact. The administration is also launching Section 301 investigations that could lead to additional targeted tariffs, and the question of refunds on how $160 billion already collected, that's a crazy thing to even get our heads around, and it's headed back to the Court of International Trade. News also dropping on Friday, the advance estimate for fourth quarter GDP. The number, 1.4% annualized growth. That's pretty pathetic, folks. That's well below the consensus estimate of 2.5% and a sharp deceleration from the 4.4 print in quarter 3, 2025. So for the full year 2025, last year, the economy grew 2.2%. Not great, certainly not strong, but decent. And it's down from 2.8% in 2024, the slowest pace of growth since 2020. That's, of course, the COVID era. Now, context matters here. The Bureau of Economic Analysis, that's the BEA, estimates that the October to November government shutdown alone subtracted a full percentage point from quarter 4 GDP. The federal government spending plunged 17% in the quarter, obviously because they were shut down. Strip that out, and private sector domestic demand actually held up reasonably well. So what we're saying is if you take the government spending out of this, the private sector is actually doing pretty well. All right. So consumer spending rose 2.4% and business investment increased 3.7%, powered in large part by the ongoing AI capital expenditure boom. And the AI spending, folks, is not in any way slowing down. The concern going forward isn't really quarter four, though. Most economists expect a bounce back in quarter one of this year as the shutdown effects unwind, except that now we are in another shutdown, at least a partial one, and the concern is the bigger picture. Core PCE inflation is still running at 3% annually, and you'll recall that the target is for 2% as established by the Federal Reserve's mandate. The Fed is in a higher for longer posture. Chairman Powell's term ends in May, and his likely successor, Kevin Warsh, is expected to maintain a hawkish stance. Now, it makes you wonder, why would President Trump bring in a new Fed chair who is hawkish? But that's in fact what has happened. With all the people from which he had to choose, President Trump chose someone who is relatively hawkish. But that's the way it works in Washington. And that brings us to the week ahead. NVIDIA reports fiscal year 2026 fourth quarter earnings on Wednesday, February 25th, after the close. This is arguably the most important single earnings event of 2026 so far because NVIDIA is 7% of the S&P 500's performance. And NVIDIA right now is the most important stock in the world. Did you catch my emphasis on that? NVIDIA is the most important stock in the world, and their earnings report is enormously important. The consensus is calling for approximately $65.5 billion in quarterly revenue. That would be up 65% year over year. I can't even say that with a straight face, but that's what it is. That is how fast this company is growing. And earnings per share of roughly $1.52. Well, Goldman thinks that the company could actually beat the revenue number by nearly $2 billion. It's just staggering. And all of this, of course, is AI, artificial intelligence driven. Here's why this matters beyond just this one stock. NVIDIA's Blackwell architecture, that's one of their big chips, is ramping up to scale. Jensen Huang laid out a path to $500 billion in combined Blackwell and Rubin visibility through the end of calendar 2026. Every major hyperscaler, Amazon at $200 billion CapEx, Meta, Microsoft, Alphabet, notice these are all Mag 7, is pouring money into AI infrastructure, and it's not going to stop this year. I don't even think it's going to slow down next year, but for right now, it's not going to stop this year. The quarter one fiscal 2027 revenue guide is expected to be around $71 billion, but some analysts think NVIDIA could actually guide above $75 billion, especially if China revenue starts appearing in forecasts. That would be the catalyst. So NVIDIA is trading at about 24 times forward earnings, which for a company growing revenue at 65% year over year is not only quite reasonable, it's crazy low, in my opinion. The Mag 7 led the market last week with an average gain of 2.3%, and the rotation into big tech, back into big tech, I should say, is very real. And the DS program is benefiting from this. This earnings report will either validate that trade or give the market a reason to pause. Either way, it's a must-watch. Watch my posting of blogs for the results of this earnings report. Those of you that are not seeing my tweets every day, you need to be following those either on our website, on Spotify, on Twitter, or Facebook. A few other items worth noting before I say goodbye. Gold surged back above $5,100 an ounce this week, driven by the U.S.-Iran nuclear tensions and continued central bank accumulation. And the banks are accumulating it because they want to hedge in case we end up going to war with Iran. Goldman Sachs has a year-end target of $5,400, not even 10% from here. But again, gold, remember, has been on a tear for the last year. Silver's also running hot above $80. So the VIX pulled back to around 19 despite all the headline risk. The European markets are continuing to outperform, at least for the time being, I don't think that's going to last, but that's how we're invested at any rate. So this broadening of global participation is something we're watching as a positive sign for international allocations. So check it out. The Supreme Court ruling that rewrites tariff law, a GDP miss that's stirring the stagflation debate, and the biggest earnings report of the year on Wednesday. This is exactly the kind of week where you need to be following me on my tweets, on Facebook, on X or Twitter, whichever you call it, and LinkedIn. All right. Follow me there. I'll be tweeting at least once, sometimes twice a day to keep you up to date. Folks, that's the weekly update for Monday, February 23rd. We are glad you're with us. Stay tuned for next week's. Have a great week ahead.